Welcome to the Capital News. I'm your host, Alex Karitis. Today is Wednesday, May 20th, 2020. Thank you so much for joining me. The title of today's podcast is The DC Power Play. Not a very busy news day for the day, so I figured we'll do a little bit of a recap. And I also wanted to highlight a couple points, some things that we have discussed over the past couple of days in regards to Jerome Powell, the chairman of the Federal Reserve, his recent testimony and interviews, as well as that of the Treasury Secretary, Steven Mnuchin, because I do think there is a power play taking place right now, some power moves, and I think these guys don't want to be the ones holding the bag. That's not a profound statement. Nobody wants to be left holding the bag, getting all of the blame, but I do think that at least at this time, this round anyway, the Federal Reserve is trying to shift some of the blame going forward onto the federal government, onto Congress, and onto this administration. And we'll get to why I think that's the case. But this is going to go back to that difference between a liquidity crisis and a solvency crisis. And again, that's something that we have been discussing because we think it's important to discuss, it's important to note, and it's also something that the Federal Reserve has been calling out. And it's always those things that they keep repeating that you have to pay attention to. Why do they keep saying these things? Read between the lines. And if I'm reading between the lines correctly, this is a DC power play because nobody wants to take responsibility. They want to shift the blame on somebody else. But to market performance, Wall Street had a strong day off of the back of nothing spectacular. There was no major headline news, no big data point that came out that justified any type of rally, but they were up big across the board. Nonetheless, right now in the futures trading, we have the Dow Jones down about 0.7%. The S&P 500 is also in the red, down 0.6%. The NASDAQ 100 also following suit, down 0.33%. We have some PMI data out of Japan and Australia we'll get to momentarily. We have the Japanese markets. They're in the red, but relatively flat. Across the pond in Europe, markets were all in the green, up about 1% on average across the spectrum there. And then in the cash trade in Australia, trading in the red, but relatively flat as well. On the commodity front, unbelievable what we saw obviously a month ago with negative pricing. And now we have WTI trading all the way up at $33.65 a barrel. Brent, the international metric, is at $36 per barrel. Natural gas down again, $1.76 per million British thermal units. Gold and silver giving back a little bit right now. Gold at $1,742 an ounce. Silver at $17.20 an ounce. And on the bond front, Uncle Sam's U.S. 10-year Treasury note down slightly further, yielding 0.66%. On those PMI numbers, we have Japanese manufacturing contracting the most since 2009. The manufacturing PMI fell to 38.4 in the month of May, down from a reading of 41.9 in the month of April. Again, anything above 50 denotes expansion. Anything below 50 denotes contraction. This is Japanese manufacturing, 38.4, biggest contraction since 2009. And of course, that was during the Great Financial Crisis. On the services front, also in Japan, PMI actually rose to 25.3, still a terrible reading, but it did rise from the previous month. It is now sitting at 25.3 in May, up from 21.5 in the month of April. On the export front, I should say, again in Japan, slumping on a year-over-year basis, 21.9%. Terrible number for the month of April. However, this was better than market expectations, where the market was guessing that it was going to be a decline of 22.7. And of course, this decline follows another terrible decline that took place in March, and that was a slump of 11.7%. So, year-over-year basis, Japanese exports for the month of April down 21.9%. For the land down under, Australian services PMI, 25.5 in the month of May. This is rising from an all-time low in the month of April with a reading of 19.6. So for May, 25.5. Still terrible numbers. This is to be expected, obviously, given the circumstances. Australian manufacturing PMI deteriorates further. For the month of May, we are now sitting at 42.8 in the month of May, down from a 45.6 figure in the month of April. So not good. A lot of this, of course, could have been priced into these markets, which is why there's not any type of major sell-off. Of course, they are contending against huge amounts of liquidity being thrown at them from central banks the world over, from federal governments the world over. So there's a lot. We got this bad data on a daily basis, and markets just keep shrugging it off. I mean, when you look at the valuations, especially here in the United States, they're just as bad as they were when we were at all-time highs, if not worse in some instances. This is completely ludicrous. It's completely off the charts. You look at what's known as the Buffett indicator, total stock market capitalization against GDP, getting close to where we were a couple months ago. Absolutely ridiculous. And in fact, we are worse than where we were at all-time highs. And the reason is because now we know how severe, or at least to a better degree, how severe this recession is going to be for this year. You have various banks of the Federal Reserve with their GDP forecasts for the second quarter predicting that the reading is going to come out at negative 40%, if not worse than that. Negative 40. That is huge. These are numbers that we have never seen before. I think during the Great Depression, the largest drop-off was negative 33%, and that's huge. So we're talking about numbers that we have never experienced in this country before. We have a $21 trillion economy. If you assume, now that 40% decline is quarter over quarter. So if you assume for the entire year that the U.S. economy contracts by 10% on a year-over-year basis, that's $2 trillion gone. How are we going to get that back? Now, we're doing all of this quote-unquote stimulus, all of these bailouts, all of these liquidity facility and all that crap, all of those acronyms coming out of the Federal Reserve and the SPV, the Special Purposes Vehicles, whatever the hell they're called, from the Treasury. We lose $2 trillion this year from a GDP standpoint. But in the midst of all of this, we've also tacked on several $1 trillion worth of debt. This is a double whammy. This is why you don't do these bailouts. This is why you do not do these types of measures. Because not only do you have to get back what you have lost, the $2 trillion in GDP, which is going to take time, but now you have to make your way through all of this new debt, which needs to be paid back plus interest. Plus interest. And what the government is trying to do is to kick the can as far down the road as possible. We talked here yesterday about how Steven Mnuchin was asked yesterday in that Senate Banking Committee hearing, Mr. Secretary, is it true that you looked into issuing some really long-dated bonds, 50-year bonds, 100-year bonds? Yes, sir. Yes, Senator, that's correct, we did. But we contracted out, some financial advisors, some consultants to see if that made sense. And we decided not to do so because there was no demand for them. Nobody wants them. Nobody wants them. 50 to 100 years to pay for these things. That means people who do not even exist, generations who do not even exist, are going to have to pay for the things that we have done today. In huge amounts. Because we're talking trillions of dollars here, people, plus interest. How is that ethical? How is that moral? How is that American? The answer to all of those questions is it is not. But without blinking, without hesitation, this is what they think about. Well, let's just pawn it off on somebody who isn't even here yet. Let's just have them pay the bill. They'll be happy to do so. And of course, nobody even wants it now. This is the system that we have adopted here in this country. Are you understanding what's going on? There is no draining of the swamp. This is a continuation on steroids. Follow the money. Who benefits? Cui bono. It's all you have to do. You don't have to go out and then read encyclopedias of information to figure this stuff out. Just look at where the money is going and who is benefiting the most from it. That's all you need to understand to paint this picture, or to really get you on the right path. Now, how deep and how far into the rabbit hole you want to go, that's your business. But if you want to get started, start there. Follow the money and ask who benefits. Well, the swamp is benefiting quite well. If you would identify them as the military-industrial complex, as you would identify them as the financial system, as you would understand them, of course, going with Wall Street, corporate America. Look at the concentration in the stock market. It's all the big tech names. Those same companies that Edward Snowden informed us about a handful of years ago already. Backdoor access to the government. They want the data, this, that, and the other. It's hand in hand. Hand in glove is the relationship here. This is not free market capitalism. This is corporatism. Fascism, whatever you want to call it, that's what it is. But do not call this free market capitalism, because that it is not. Do not call this a constitutional republic, because that it is not. This is a banana republic. And if we continue with these asinine, fraudulent policies, it's going to be a banana republic on steroids. We're going to put Zimbabwe, we're going to put Venezuela to shame. I take no pleasure in saying this. And personally, I do not think I'm being hyperbolic. Maybe you do, and that's fine. We can have those disagreements. But when you're talking about trillions of dollars that we do not have, that needs to be paid back plus interest, we're going to lose $2 trillion in GDP this year, maybe more. Multi-trillion-dollar deficits just for this year alone. And if we do not get some sort of miraculous V-shaped recovery, well, then it's just going to continue into next year as well. And we already know how bad so many individuals, families, and small businesses are struggling right now just to stay afloat. Just to stay afloat. And this is with all of these stimulus bailout measures, the unemployment insurance, the extra $600 a week if you're getting it, the $1,200 checks, the PPP loans if you've been able to get them. Even with all of this, because this goes to the heart of the difference between a liquidity crisis and a solvency crisis. And what we have witnessed, what we have listened to over the past couple of weeks from the Federal Reserve is this very point. Hey, look, you can look at our balance sheet. Those numbers are going to come out tomorrow, by the way. It's Thursday, so we'll get an updated Federal Reserve balance sheet number. You can look at M1, M2, the money supply, which is, of course, hand in hand with what's going on. We have all of these facilities out there, says the Federal Reserve. We're doing this. Look at what we're doing. Perfectly fine. We're allowed to do it. It's within our charter. And anything that was above and beyond, well, we got that SPV. We're signed off with the Treasury Secretary, so we can't do anything unless he gives the go-ahead on some of these other things. They're washing their hands of this. We've thrown in trillions of dollars. We're going to go after bonds, investment-grade bonds. We're going to buy them directly from companies if we want to, and we'll go on to the secondary market. We'll do both. We'll even buy junk bonds. And they're starting to get into those ETFs as we speak. A lot of the new issuance of treasuries, we'll buy them up because nobody else will. So the Federal Reserve will do that too. Mortgage-backed securities, residential and commercial, not a problem. Not a problem. See, we're doing everything we can for the American people, throwing all of this liquidity out there. But, and here's the power play. There's only so much we can do. That solvency problem, that solvency issue, yeah, that's going to have to be put on Congress. Well, can you elaborate further, Mr. Chairman, on what you think Congress should do. Oh, no, that's not my lane. I'm just talking at a high level here, as he says. It's up to you, Congress, to come up with those things. It's up to the administration to come up with those things. This is the Federal Reserve attempting to wash their hands. We flooded the market with liquidity. He admitted as much, Jay Powell did, on Sunday on 60 Minutes with Scott Pelley. You flooded the market. You just printed money. Yep, that's a way of looking at it. That's what we did. Look it up. That's what he said. But this is really now a problem for Congress. Remember, because Jay Powell also told us that the usual suspects are not guilty. They're nowhere to be seen. They're nowhere to be seen. This is all the doing of COVID-19. This is a global pandemic that came out of nowhere. Nobody could have seen this coming. Shut down the entire global system. So inflation, asset bubbles, oh no, none of that existed. Did not exist. It was a great economy. All because of COVID-19. And all of those comments that we had made throughout 2019, the BS trade headlines, the BS trade deal, which of course is falling apart if it ever existed to begin with, because of the blame game and everything else. The $1 trillion deficits before COVID-19. The financial asset bubbles at valuations at levels we have not seen in years, comparable only to the dot-com era or the roaring 1920s. But there were no bubbles, says the chairman of the Federal Reserve. There was nothing wrong. Everything was humming perfectly along. Then you have to ask the basic question, which we did throughout the entirety of 2019. Well, then, why are you cutting interest rates or talking about cutting interest rates? Why did you? If everything's great, now's the time to start increasing them a little bit if you need to cut interest rates to fight off or fend off a recession. Or if you're attempting to normalize your balance sheet that has been out of control for the past decade. And now the Federal Reserve wants to make the argument, well, as soon as we're out of this crisis, we'll then go and do the same thing. What a bunch of bull. You couldn't do it then for the last one, the great financial crisis. Bernanke didn't normalize. Janet Yellen didn't normalize. Jay Powell tried to for a handful of months. Wall Street throws a hissy fit. The president throws a hissy fit. Oh, no, we're done. Interest rates got to 2.25%, 2.5%. This was supposedly, according to the president, his administration, and even some members of the Federal Reserve. Oh, this is such a great economy. It's the best we've ever had. Well, it's just roaring along. But we can't tolerate 2.25%, 2.5 percentage points. Well, then it's not a strong economy. Very simple. Very simple. If we cannot stomach 2.25%, 2.5%, then we have a weak economy. And now, given a couple emergency Federal Reserve meetings, we're at the zero bound. Of course, they say that they're not contemplating negative interest rates. On a real basis, we already have them. And on a nominal basis, they're just around the corner. Just wait for it. They'll be here. They'll be here. But when it comes to the Federal Reserve normalizing after this crisis, I don't think so. What does normal mean? Get us back to where we were before this? So now, okay, well, Federal Reserve balance sheet at $4 trillion, that's where it's going to stay. Before, we thought normalization might be $1 trillion, maybe $2 trillion. Now, once this thing ever passes, it's going to be $4 trillion if that's normalization, because we're at $7 trillion, and this is just the tip of the iceberg. This is just the tip of the iceberg. We were told by both Powell and Mnuchin yesterday, all of that money that has been appropriated from Congress with the CARES Act or the Nobody Cares Act, there's still a lot left. There's still a lot left. And when it gets into the hands of the Federal Reserve, because of fractional reserve banking, it'll be levered up. It'll be levered up. So we're at $7 trillion on the Federal Reserve balance sheet, thereabouts. We'll get the new number out tomorrow. They might do more stimulus. Government doesn't have it. They're broke. We're borrowing 50 cents on every dollar that we spend. Is that sustainable? They might do more. They're broke. The only way they're going to get it is if who? the Federal Reserve steps in and says, yeah, go ahead, Uncle Sam, issue more debt. We'll buy it because nobody else wants it. So that'll expand their balance sheet. How much more? $1 trillion, $2 trillion, $3 trillion? What's $500 billion, $1 trillion amongst friends? So we have no idea when this is going to end, but we're at $7 trillion. It goes further. What is normalization going to look like? And free was never so expensive. Remember this. Very good podcast, if I might say so. Check that one out. Free was never so expensive. There is no free lunch. And of course, none of these jokers in the Senate ask this of either Mnuchin or Powell. Is there such a thing as a free lunch? What are the limitations? No discussion of this at all. No pressing questions. Grandstanding, trying to get political points, some good back and forth. We discussed those points yesterday. But these politicians, it's politically convenient for them. It's politically profitable for them to stand behind these guys or to stand on their shoulders, as opposed to going to their constituents and saying, hey, you got to wake up. Too many people live beyond their means. We got too much debt. Deficits are out of control. Debts are out of control. Unfunded liabilities are out of control. Everybody's living style out of control in the aggregate, unsustainable. You want to pay for all this stuff? Well, we're going to have to raise your taxes. No politician wants to do any of that. They don't want to tell you the truth, and they sure as hell do not want to tell you that you got to pay for it. At least not directly. But if they can follow behind and hide behind a Treasury Secretary and a chairman of the Federal Reserve, oh, well, then by all means, let's have everybody pay through it, through inflation. And that's what's going to happen. That's what's going to come. You'll see it with inflation. We're already starting to see it in certain areas, which we told you was going to happen. It's just getting started. We'll get it with stagflation because that's inflation with a stagnant economy, which we're in the midst of, and it will continue if our analysis is correct. And if they continue to try to, quote unquote, stimulate themselves out of this, well, then that's going to be more borrowing, more deficit spending, more money printing. It'll turn into hyperinflation in due time. Again, this is a process. This is a process. Will we have deflation in some areas, the effects of, lower prices, of a contracting monetary supply? Because remember, there was normalization, and there is a lag between policy as to when it hits the market. But we will see prices come down in certain areas. We're already seeing that because the demand picture. But again, it goes back to that question we've been discussing here for quite a while. If you have a basket of goods and a handful of those goods in that basket are things that maybe you used to buy, but now you don't want them or you don't need them, what do you care what the price of them are? Especially if a whole bunch of other goods and services in that basket that you do need, the necessities, food, utilities, transportation, etc., what happens if those go through the roof? You don't care what the fancy tech gadget gizmo is. You need to eat. You need to feed your kids. What are those costs? Okay? So pay attention to that. You can have both. But where does this end up playing out? My analysis, my opinion, is on the inflationary side of things, especially for the things that matter. That matter. Now, what is Congress and this administration going to do about the solvency crisis? Because the Federal Reserve is 100% correct. They can deal with the liquidity crisis because they have a printing press. They can throw as much money as they want. They have a digital printing press, as the chairman said to 60 Minutes. It's just digital currency. We're just going to print it on the screen. But if we have to print it, we also have the printing press, and we can do that too. So liquidity is nothing. They can throw it out there, and they do. No accountability, no oversight, whatever. But the solvency aspect, how do you get people back into businesses? How do you get people back into hotels, back into airplanes, back into rental vehicles, back into shopping malls? It's a little bit more difficult. And how can the government even do that? Right? It becomes difficult for the government to do it too. But at least with what the government's doing, they're giving people money. Of course, government doesn't have it to give. That's why we're going to pay for this big time on the other side. They don't have it. If they had it, you could say, well, at least they had it, and now they're just giving it back to the people. because the government doesn't make money, it takes it from we the people. So this would just be giving it right back to them. Problem, this time we don't have it. So you're going to have to pay for all of this through the printing press, which by definition is inflation. Depending on the business, and so many of these businesses, so many of the people directly affected by this, and maybe disproportionately to the negative side, are people who have an annual income of $40,000 or less, what the Federal Reserve told us. 40%. 4 out of every 10 Americans making $40,000 or less has lost their job over the past month and a half. 40%, that is a huge number. And we're going to find out, obviously, more tomorrow with the initial jobless claims number. It's Thursday. Typically, that's a bad number, so that's a reason for Wall Street to rally. So expect that to happen because that's been the trend. But we'll see if that breaks tomorrow. Maybe that's why the market rallied today in anticipation of a bad initial jobless claims number. And so let's just get Thursday over with today on Wednesday. So we'll get that number, and then in a couple weeks, the first Friday of June, we will get the jobs report for the month of May, and we'll probably do what we did this month for April's number, and we'll just read the entire jobs report in a podcast. We'll just do that because I'm sure it's going to be another historic report as well. So these are devastating numbers. This is the argument about solvency. These people aren't working. Are they going to be called back to work? Because a lot of these people work in those service industries. The hotels, the airlines, the airports, the restaurants, the bars, concerts, catering companies, sports venues, these types of things, which takes up a significant portion of this country's economy, especially when you look at all of the second and third order effects. Those other businesses that exist because, well, these people are working, so they got some money to spend, so they're going to go to their, to their own little coffee shop, something like that. Well, is that coffee shop in business now? Will they be able to make it? These are the questions that nobody really has the answers to. We're trying to do our best here, looking at this logically, and we think a lot of these smaller companies in particular are going to be wiped out, and they are not going to come back anytime soon, if ever. If ever. And if we truly had a free market capitalist system, at this juncture, we would be seeing a lot more bankruptcies. We would be uncovering a lot more accounting fraud. Make no mistake about it. Again, I go back to the Ponzi scheme with Bernie Madoff. Had it not been for the great financial crisis, Bernie would still be in business. Or if Bernie had a printing press, he would still be in business. Well, the great financial crisis occurred, and he doesn't have a printing press, so he's in jail. But our government has a printing press. We're operating a Ponzi scheme, but we have a printing press. And the government, by its very nature, is an institution of force. So they got a couple things going for them to keep people in line, and then they can print the money. So this whole Ponzi scheme can keep itself moving. At our expense, of course, but that's the system. It is in our face. It is that ridiculous. It is that crystal clear. And nobody cares. The Nobody Cares Act. I guess it has a double meaning. So this is what I think is transpiring right now. The Federal Reserve is attempting to shift the blame to Congress and to this administration if and when things get worse. Because they can say, look at our statistics, look at our balance sheet, look at the money supply, look at all of the facilities we opened up again. We did everything we can from a liquidity standpoint. Now the rest is up to you guys. And it's Congress. So it's partisan. These things are supposed to take time. By default, by design, government is supposed to be slow moving. So things are going to get messed up. We've already witnessed a lot of the mess up when it comes to PPP, the unemployment insurance. 60% have it, 40% are still struggling to get it. They've gotten nothing. Some people are still waiting for their $1,200 check, although most people, I do believe, have received those by now. But that's what's going on here. Now, make no mistake about it, that the Congress, that the Treasury Secretary, and that Donald Trump, at the drop of a hat, will turn around and start blaming the Federal Reserve too. But this is all positioning. This is all jockeying. This is money. This is power. This is legacy. This is reputation. This is institution. These people who run these institutions are positioning themselves to cover their rear ends. Because nobody is a leader. Nobody wants to tell the people the truth of what's going on here. Living beyond our means, the debt, the deficit's unsustainable. Don't worry about it. Don't worry about it. We'll print the money, we'll spend the money, and everything will be okay. We'll have a V-shaped recovery. Don't worry about it. Social distancing, it was only a thing that lasted a couple months. We'll be completely back to normal in no time. Hey, I hope we are back to normal in no time, although I do think normal was not sustainable. So I do take a little bit of an issue with that. But when it comes to the health aspect, yes, 100%. 100%. The economic way we behaved before, no. There was nothing normal about that. That was insanity on steroids. Okay? So the government is going to have a tough time keeping all of these companies afloat. We're a $21 trillion economy. You think throwing a few $1 trillion out there is going to do the trick? We already know it's not going to do the trick. And we already know where most of that money is going. Follow the money. It's not to the mom and pops. It's to the bigger guys. It's to those who are connected, have a stronger relationship with the banks. Even if they weren't small businesses, they got the dough. All about consolidation. Make no mistake about it. There is no draining of the swamp. If there was, most of this money, if they're going to do it, would have went to the smaller businesses, period, end of story. Because they don't have access to a lot of these financial markets. But guess what? Publicly traded companies, they do. That's why it was so ridiculous that we bailed out the airline industry and so many others. They can issue stock. They can go into the bond market. They can do a whole host of things. They have better relationships with their banks where they can get that type of money. Your smaller businesses don't. And they're the ones struggling, and they're the ones still waiting. So don't tell me somebody's draining the swamp because it's not even close. And it's in your face. And they all sign off on it. Powell at the Federal Reserve, Mnuchin at Treasury, President of the United States, Republicans in Congress, Democrats in Congress. It's entertainment. It's wrestling. They're all best friends behind the scenes. They all sign off on the same garbage that you're all going to have to pay for, that your children are going to have to pay for, that your grandchildren are going to have to pay for. And if they had their way with the 50 and 100-year bond, it would be your great-great-grandchildren. They don't care. But they're running away with the loot. This is the rats abandoning ship because they know what's coming. Because when the Federal Reserve Chairman tells you there's a difference between a liquidity crisis and a solvency crisis, he's telling you that the solvency crisis is underway. It is coming. And you better do something about it. But he's not going to come out and say that directly like I just did, because that would scare the hell out of the markets. What is completely logical and for everybody to understand, he's not going to say it because he knows what chaos would ensue if he said that, because of how much power he wields as the chairman of the Federal Reserve, which is also a disgrace to this Constitution. But there you have it. The DC power play is taking shape. And don't forget, this is a presidential election year. So things are really going to get nasty over the coming months. Politically, economically, socially, especially if everything opens up and it doesn't go as well as people are hoping. Watch out for protests in a theater near you, because they are most definitely going to pick up globally. Thank you so much for joining me today, ladies and gentlemen. Please like, share, subscribe, get the word out, leave your comments. We do love hearing from you. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.